I am very excited to welcome Ferg, also known as Trader Ferg on Twitter. He is a man who, and this is very rare, accurately predicted everything in 2021, just about. Welcome, Ferg.
Thanks for having me back.
No problem. Like it's funny though because we talked a few months ago, and a lot's happened since then. And I'll read these articles like Vladimir Putin blames the Green Initiative in Europe for the energy crisis. Ferg was saying that a few months ago. Thanks for finally joining the party, Vlad, right? And then like Elon Musk, obviously criticizing energy in Europe and going into nuclear, and just literally everything. Countries turning to uranium, right, for their green initiatives, UK, France. And then obviously the spike in oil, like no one else saw, even coal, no one saw coal spiking, right? So, the big question is kind of where we are now and where you think we're heading with all this.
Yeah, the policymakers are going to push it to the extremes. So that's one thing you've always got to learn, is just because it's obvious that it's not going to end well doesn't mean they'll stop it anytime soon. So,
yeah. Well, it's really, oh, sorry. No, it's just so interesting because you hear like these big talking heads, right? Like Cathie Wood talking about how, supply chain disruptions, it's going to be deflationary like usual. And, tech stocks, you should just keep buying tech stocks, right? Because this is all transitory, and oil, obviously the demand's going to be down in a few years. So you don't want to buy the big pumps now and things like that. But do you think this is going to be transitory? Are you in these trades like oil and uranium for a trade, or is it more of an investment?
Well, you never want to call them an investment because they are cyclical. So in nature, they'll run their course. But no, the whole transitory narrative's already cooked. You can just you see all the even recently with like the Fed, they're all I think it was in the last meeting it was mentioned 16 times and it wasn't mentioned at all in the past meeting. So they just want to give it the silent treatment, but they've already that whole transitory narrative's been steamrolled. But Cathie's interesting because she's got to stick with the deflationary narrative. Like ARK is essentially the inverse of oil.
Right.
So if oil takes off, she's screwed. Yeah, that ARK's going to implode. So that's why everything she talks is deflationary, because she's essentially ultra long duration. Like that's what she's created. She's created a basket of ultra long duration, and if inflation takes off, she gets crushed, and it's that simple. So that's kind of
exactly.
I view that.
And it's already completely taken off. They're just like way more than anyone expected. We're in stagflation, and I agree. Like they have been kind of proven completely wrong. Like no one was prepared for this except for you and a few other people, pretty much buying coal and natural gas and things like that. But many people still think that this is going to be. They think, it's getting a lot farther than we expected, but it's still going to turn out to be transitory. Partly because like demand for oil now or a year ago versus in 3 years. It's going to be kind of flat. So they think it'll kind of, mean revert. But why do you think it's here to stay?
I would like the start of that question is people just fundamentally misunderstand how important energy is in the economy. Like it's just in everything. Like it's a massive input to pretty much every part of the economy, like whether it's food, whether it's just all materials, whether it's like even when you think about how like economists kind of break down like kind of what do they have, like land, labor, capital, and entrepreneurship. Like labor, when you think about it, all it is energy. Energy provides the majority of sort of the leverage we have on labor. Like you're not out sort of doing manual work anymore. It's the main multiplier, and we've just got used to super cheap labor and super cheap energy. And now we've kind of taken that for granted, and we're going to find out just how painful it is when those things go higher, and just how many things are tied to it. Like it's crazy, some of the sort of knock-on effects, like going with something like natural gas at the moment, like gas spikes. And so you can't make ammonia because a lot of what's happened in a lot of sectors is because a lot of the prices have just gone down. They haven't really worried about hedging. They've tried to move further up the value chain and capture a good margin there and made more because the commodity kept going lower. So now they're getting absolutely screwed when the commodity spikes higher. So using like ammonia or fertilizer as an example, when it spikes higher, they either have to close down or their input costs like triple. And so fertilizer goes higher and spikes, and then the knock on of that is going to be food, and food's already been spiking, and that was before fertilizer went higher. So I put up a chart on Twitter last night just showing how food's just in real terms broken to sort of a high we haven't seen since the 70s, and this is before all the higher costs of fertilizer feed through. So that's obviously going to have a lagged effect. And once food takes off, you're in a whole world of hurt for inflation. You can kind of hide from a lot of different inflation. You can't hide from food inflation. Once that starts to feed through, then that combined with energy, high energy prices is going to cause an awful lot of pain. And I think we're just seeing the start of that. So that's really going to absolutely murder this whole transitory narrative, and cause a whole lot of cause a whole lot of pain, unfortunately. Like, it's going to price a lot of the poorest people out around the world, but it's also going to gradually start to turn voters against a lot of these ideologies. Like, they'll keep pushing them until voters vote them out because they've caused too much pain. And so, I see that's the big picture, but how far it'll get before that sort of threshold is reached, I'd say maybe on the short term, and maybe it's after an extremely painful winter, but maybe it goes on a lot longer. It's always been my shortcoming is thinking things would play out quicker and being surprised when they keep going a lot longer than I would have ever thought. And I think history kind of reinforces that.
Wow. So essentially all these different, pretty much every input is going up, and they're all interrelated, and they're all causing spikes in prices. And like you're saying, labor, like everyone is saying, oh, we're not 1970s again because labor, like it's staying low, right? But now, like, the great resignation, I honestly don't know why so many people are resigning their jobs and just not working the minimum wage jobs. I have no idea, but those prices are going sky high, or they have to if they want to keep people. So it's all related, but so there's nothing they can do to kind of bring it down, you think, the leaders?
I do. You got to understand the game that's been played. So it's the idea that they essentially have to inflate away the debt. They can't. You really comes down to three options. You've got like austerity, you've got default, or you got inflated away, and the first two are just unacceptable. So it always comes down to inflated away. And so the Fed can't exactly say that that's its aim, because then you scare the pants off the bondholders. And the problem with that is, like, the majority of bondholders are foreign, and like it was last year, it's like 65%, and that's been dropping rapidly. And obviously the Fed has to take up slack with that, which is even more inflationary when you think about it. And so it's it's kind of that they're stuck with this. They're stuck in this quandary of sort of saying there is no inflation, because they always point to CPI, and CPI is the most manipulated figure. Like, there's never an adjustment to CPI that sends CPI higher. It's always just how to manipulate it down, and then you kind of start thinking about, are they going to start yield curve control? And whereas everything, like real wages, just were negative, whereas across the board, all your costs are going higher. And so it's that's just a recipe for disaster, and it's gonna have huge ramifications, really, when you because
the populace is going to get upset, right? It's
going to get upset, and they're gonna, and it's just going to cause an awful lot of pain. I've got this bigger theory that, like, when we saw Bezos fly his big dildo into space, that was the peak of, like, capital over labor. So we've pretty much optimized for capital for the last few decades, and now we're going to see a period where we have to kind of optimize for labor, because there's just going to be such an uproar with constantly rising costs of living, and people can't survive on the lower wages. Like I've got this chart of median wages in the US haven't gone anywhere since the 70s. So it's still like 50 odd thousand. And so, yeah, that's gonna have to change. And it's interesting to see it all start to, I think this is really kind of a big inflection point in time because we've seen this start of the pain with kind of energy prices is going to keep feeding through to lots of different areas.
Yeah, and just staying on macro for a little bit more, because it's just so important, and it kind of sets the framework for everything. So you're saying that eventually the bond, because the Fed probably just wants to keep everyone kind of like passive, all the bondholders passive, and if that's possible, then maybe they could keep yields low, even though real yields will be terribly negative. But keep yields low, keep the bondholders happy. Maybe hope some of the supply chain disruptions go away, and then then the bond yields don't spike unsustainably high. But you're saying inflation will probably cause bond yields to just be unsustainable, and it's going to be this vicious spiral that we're stuck in for a while, right?
Yeah, well, depends what the Fed does. If it tries to like buy them all up, essentially, it's just there's a few different ways. Like you either have rates spike, but then they can't spike too far because then can't service the debt.
Right.
So they have to step in at some point with some sort of yield curve control, and then the currency becomes the blow-off valve. And so then, the US dollar gets crushed, and obviously commodities go through the roof. And it is one interesting. Like I've listened to a lot of Luke Groman, which I'd recommend to anyone if they want to kind of get up to speed with macro. Is just listen to Lynn Alden and Luke Groman, all their podcasts. And he's got draw some great sort of analogies with the Germans, where they you've got to try and, on one hand, you've got to try and tell the bondholders they'll be okay, you're not going to inflate them away, and then on the other hand, you've got to tell all the population that sort of interest rates aren't going to rise, and you're going to keep giving them all the support and all the stimulus, and keep all the sort of unsustainable programs in place. And sort of he calls it like trying to ride two horses with one ass or something. It was along the lines. It's just unsustainable, and it's you should never look to them to tell you the truth. Essentially, they'll keep lying to try and keep up the facade as long as possible. Yeah.
Wow. Yeah. And a lot of commodities investors have been hurt for so long believing believing what you're saying, right? This trade, and they've been wrong essentially, because they've been able to keep it. But now it seems like the genie is out of the bottle, and here we have really bad stagflation. You've been absolutely correct, unlike most people, and you've been in coal and things like that. So, the big question is, how can people kind of protect themselves in this environment? It's so funny. I have to call this out, because last time we talked, Peabody Energy was at $3 or two something, maybe mid threes. And you were saying, the float is low, it's primed for a short squeeze. And, here we are. I think you said you were up 6x in the name. So that is just so awesome. But but if you were building portfolio today, because a lot of people are building commodity portfolios today, how would you kind of go about, investing right now?
Yeah, it's tough now because everything's running hard. It's a very different setup than even 6 months or a year ago. I think the spotlight has yet to move on to oil, so there's an awful lot of opportunity there. Like I think that's the next sort of shoe to drop, is people still think that the supply demand isn't that bad, and that OPEC can sort of paper over the supply problems, where I don't believe that's the case. And so I think this is going to be quite a big structural deficit once demand returns, and we're just going to see the sort of the natural gas and coal story all over again in another few months. So I'd say if I was starting again now, I'd have a large oil exposure. Also, just the risk reward of the spot physical uranium trust is just, yeah, that's still a no-brainer. That's probably the easiest, like sort of like low, like great risk reward trades right up until you're in the 70s or $80 a pound. That's just like just the basic incentive price. That's just almost free money. And then from there, it'll overshoot. Yeah.
Yeah.
But then obviously it's speculation once you probably get above 100, how high it goes. But yeah, this range from now to sort of $70, $80, that would definitely be a large part of the portfolio, because that's just a great sort of risk adjusted trade. Coal's an interesting one because everyone sort of thinks coal's run, and Peabody was really a post bankruptcy sort of play. Like they sort of scared the market so that they could give the bond holders another haircut, and sort of threatened the second Chapter 11. So that was why it was kind of priced the way it was. So that was a bit of an anomaly there. But even the rest of the players, like everyone sort of thinks they run, but they haven't actually. They're compared to their cash flows, a lot of them have actually got even cheaper when you consider what coal's done. So the whole coal space would probably, if I was to start again today, would probably make up at least a quarter of the portfolio.
Wow.
I think those are just going to be cash cows. They're not going to get any multiple expansion because no one's going to touch them. No one, yeah, everyone still hates them, even though they're they're just going to pump out cash at these levels, and even if things retrace a bit. The interesting one I've been digging into a lot lately is just trying to like understand where the whole regulatory sort of thinking is going to go with like policymakers, because like kind of understanding the like I saw something the other day from the head of the IEA, and he's saying like the oil and gas capex is where it needs to be, i.e. sort of heavily underinvested, but we need to sort of the renewable investments only at a third of where it needs to be. And so it's kind of easy to see that they're going to really push a narrative, sort of tax any profits from the dirty to fund the sort of the green. And so it's kind of important to understand that that's probably going to rear its head in a big way over the next year or two. And so a lot of, like, just looking back at history, and a lot of the producers that did really well, they'll probably get absolutely hammered by sort of super taxes and regulation and carbon taxes and all sorts of things. So it's not a matter of just looking at what did well in the past. Yeah. So yeah, that's some sort of basic. What else in the portfolio? That's kind of it for now. I haven't gone back into tankers. I'm kind of looking for probably what I'm going to dig into a lot over the next month was like how to play food. I think food, if I can find some good asymmetry there, then I'll dig into that. But yeah, that would probably be how I'd rebalance a big chunk in Sprott, the physical uranium vehicle, and some of the smaller guys around the outside to give a bit of torque, a whole lot of coal and a whole lot of oil.
Wow. Yeah, just a perfect 2021 portfolio, at least coming into the year, what you just described. But so now you're saying you're still kind of playing that a little bit, looking for more asymmetry. And uranium is interesting because I had John Polemy on, and he was saying that this is going to take 18 months, I think, to resolve itself before they can actually fill the hole for the Sprott tracker is actually leaving in supply, versus demand. They're not going to be able to bring it online that fast. So it's hard to time it, right? Because it makes sense. Like once it hits, 80, maybe $100 per pound, well, that is the trigger for massive supply to come on. But it could also take 18 months. So like, should you just like hold until that gap starts to fill? Will the narrative cause these things to go down, like, the prices to go down before the gap is filled? So how do you kind of time that trade for uranium? Because I'm sure you're up a lot. So it must be hard figuring out when to take profits.
The first is to understand that supply is not a click your fingers overnight because it hits 90. Like to bring a uranium mine on is like sometimes between 6 or even 10 years to bring them on. So and then you've also, like most sectors, when you have a brutal bear market for better part of a decade, you lose all the sort of the workforce and the knowledgeable people are all gone. So to think that the supply is just going to ramp isn't going to happen. And it's also something I've been thinking about along the lines of this sort of inflation, is a lot of the stuff that we kind of thought was out of the money on doing sort of all-in sustaining costs. So they're going to need to be reworked. If we have oil at 150 a barrel, we have labor, like it's going to be hard to get labor out there. It's going to be hard, like just pile all that up and then rework your figures. I think a lot of what was out of the money is going to become a lot more out of the money. And that's why I won't be exiting exactly because it hits incentive price. If anything, I think what's happening with sports going to make, like, it's just going to be financially engineered squeeze. So we could see something crazy, and the supply gap doesn't actually rectify itself. So you'll see sort of a crazy blow off, and then you'll see it sort of come back down, and then it'll have to sort of bounce around as people still try and bring it on. It's not like what we had last time round. It's sort of 2005. If you were looking forward, you would have had 72 million pounds surplus 5 years out. Now it's pretty much that deficit. And so it's a very, there's no sort of, it's not a supply disruption. It's a structural deficit, and same goes for oil. So no quick spike can fix it. So it's a very different thing. It's almost, I've talked to a few people about this, because sports are almost going to make it quite hard with the uranium thesis, because you can't, it could be a financially sort of engineered squeeze. If they just go after every last pound and drive it to some crazy figure, then you're going to have to kind of get out of the thesis early. And so, yeah, I guess I'll take that. But I'll definitely be writing that up, and probably start trimming at 100 sort of, and then be taking a few percent off from there all the way till it just gets absurd. I think the lesson is, I think there's a lot of money floating around out there, and things will probably be a lot more absurd than we could possibly have considered.
Yeah.
Okay,
cool. So that's kind of the timing on uranium. So it's still kind of a decent entry point because you said free money. But it is interesting because the Sprott Uranium Trust, do they ever have to sell uranium?
Yeah, well, I've seen a few people ask that question, and like, what is the actual exit strategy? And I think they don't exactly have an exit strategy. I think their whole business model is just clip the ticket on raising it and have the management fee. They don't have some big grand exit strategy at $200 a pound or something. They're just going to keep squeezing, keep raising funds under management. Like I haven't seen any grand exit strategy at some price. And you've also got I don't know if you've seen, Kazatomprom's just launched like their own physical fund now.
Oh wow!
And so that's almost like an East versus West thing. Like they're seeing this hoover up a lot of pounds, and they know that it's interesting that the West is kind of stockpiling it when it's the East that needs it. And so there's kind of this, so now they're creating their own stockpile. So this is going to be more pressure. It's just more of a squeeze.
Crazy.
So I think the problem with uranium will be getting out too early. So that's going to be pretty uncomfortable. It's kind of a weird setup when you have a whole lot of deep value investors get in, and then they get put into a hell of a momentum trade. It's pretty testing. Yeah. Good problem to have.
Yeah, right, exactly. And but that's so interesting. I never even thought of that, because once Wall Street realizes something works, they start pumping out these ETFs. Like there's so many physical, well, there's a handful of physical gold trusts. It's not just one. Like there's all these different vehicles around it, and that's going to cause the price to go up even more. But as far as like outflows go in the ETF, like what if people just start to sell? Like, would that cause them to sell some of their, I don't know exactly how the mechanics work, but will anything trigger them to have to kind of all of a sudden like just sell off their stock because of outflows or anything?
It's closed in, so they can't. They don't have to. Yeah, they'll just trade at a discount, so they don't have to sell. Yeah,
wow,
it doesn't work like that. Yeah,
and so
they'll, and it's like it. Yeah, I've heard a few people kind of compare it to like gold trust or silver trust. It's not the same because you've inherently got like utilities are inherently short. And so every additional pound that they need that goes into the trust, they're a little bit more short. So I've kind of compared it. It's like a slow motion short squeeze on the utilities. Just every day they're getting a few percent more short that they'll need to buy back. And it's, it's going to have a predictable outcome at some point.
Well, and have you noticed a sea change in terms of the regulation around uranium? Because like there were three last week, just major articles about governments saying uranium is our focus for the green energy movement. That's it. Like they didn't say renewables, they said uranium. Japan, France, England, and I'm sure others. Could this become kind of like this growth like sector where regulation is behind it? It's almost like the carbon offset trade. Have you heard about the carbon offset trade?
Yeah, I've seen that.
So bullish that. Could uranium become this kind of just like mass kind of growth sector that people invest in? Government?
Yeah, it should be. Anyway, it is the answer to the problem that we're having. Like I saw someone had like a sort of a thought experiment that if nuclear energy was invented last week, it would be the solution to climate change. We'd be running around cheering, and it's just got all this sort of negative baggage with it. Yeah. But you are seeing the ship slowly turn. Like it's stupid that at this point the main beneficiary has been coal because of the underperformance of of sort of renewable investment. I think that'll be another shoe to drop, is the understanding that it's not because we've underinvested in renewables, it's because renewables are just insufficient to supply power. It's just, it's as silly as like replacing a gigawatt nuclear plant with a gigawatt of renewables, or the nuclear runs at sort of 80-90% capacity factor and the renewables are 10 to 20. It's just they're orders of magnitude lower sort of power density, and then their orders of magnitude you've got to put in that much more of them, and then even then you don't solve the problem of sort of the duck curve, like the fact that solar only produces in the middle of the day when you need the majority of your power in the morning and the afternoon. So then it all gets put onto storage, and storage, we just don't have storage options at the moment. It's all in the it's just anyone that says we can scale storage is smoking something pretty strong.
Right, exactly. That's why I love these articles coming out, and Elon Musk saying, support nuclear because you don't want to turn into Germany where they close them down and now they're just like using coal, like the dirtiest thing ever. Just such a joke. But that's what I do like about a lot of your trades, because whether it's inflation, deflation, there's a supply demand dynamic, and the holes have to be filled. It's just math. So great. So you're still bullish uranium even at this level, and just thinking about some asymmetric trades. You're saying oil and coal potentially, but I actually have a question because in the U.S. we have huge oil companies like Schlumberger and Halliburton and like these big oil service companies. Natural gas pipelines. I've heard you talk about tankers and other, the offshore drillers and things like that. But are you bullish kind of any kind of oil infrastructure play at this point?
Yeah, well, I've just done a whole presentation, Crux, on like the idea of sort of picks and shovels. And so this is the idea of kind of avoiding the producers because they'll have a target painted on their back for policymakers, and it's on top of what's already happened to them. Like we've already seen them sort of have the ESG crowd jump aboard and be backed by the likes of BlackRock and Vanguard and take over seats and push them to transition to green companies and not invest in their oil businesses. And so already they were kind of less attractive from that aspect. And then I think we're going to have the sort of the profits that they do generate from that oil business. There's going to be sort of taxes coming for them. So I think a lot of the sort of the more service plays, like that's where like picks and shovels comes from, the idea of like the gold rush, where the everyone sort of participating in the gold rush didn't actually make any money. Anyone hunting for gold, it was the guys that were selling them the services, the picks and the shovels, were the guys that made all the money. And so it's this idea that if you can get good margin expansion from sort of oil, an oil boom, then that's probably a great way to position yourself, similar to what I've been doing a lot of is buying just a WTI future options, such as straight commodity plays, service plays, and even royalties. Royalties are actually an interesting way. They trade at a bit more of a premium, so they're not as cheap, but they kind of more asset light, so you don't kind of get your margins squeezed by inflation. They're harder to go after. Sort of, yeah, they could be taxed. Anything could be taxed, but it won't be as straightforward as taxing sort of a producer for how much oil they produce. Yeah. And so that's kind of a bit of a framework that I'm approaching it with. Yeah.
It's a very nuanced approach. So they would go for like the people pumping it out of the ground, not so much not so much like the people going out to the offshore tankers and things like that. It's like, I guess, tobacco. They're not going to tax the truckers or whatever that move the tobacco. Cool. Yeah. Okay. So does it matter the jurisdiction in terms of oil investment? Like US, like, is that?
I don't. Yeah. I tried to dive into like how to get kind of exposure outside. Obviously exposure in countries that don't care about ESG, like Russia, is a lot more attractive. If I wanted some sort of big pension trades for my portfolio that had nice dividends, I'd be buying Lukoil, Gazprom, not Gazprom, Gazprom.
Right.
And but yeah, I'm obviously far more out the risk curve, and I like my multi-baggers. So yeah, I'm usually sticking with far smaller plays that are far more hated. So yeah, and I just anything that's in an ETF or at risk of these sort of ESG pirates jumping aboard, then I'll just avoid that. Yeah.
Yeah, no, that's so good to know, because I was looking at these infrastructure ETFs, like, oh, like, look at that, safe money, kind of just diversified. Don't have to think too much about the investing. I know you're all about doing the hard work, which is great, into the due diligence. But okay, got it. And so that is a really interesting kind of scenario, and I think it makes a lot of sense that as oil prices skyrocket, right, because of the underinvestment, the government is going to try to tax them and disincentivize all investment into it still, even though and probably move towards uranium. They're going to do that in order to fund the green movement. It makes sense.
And that's where uranium kind of wins on both accounts, because uranium is essentially ESG compliant. Because we're already seeing kind of a lot of the ESG type investments already implode, like the underperformance of like solar and wind, and the rest of the ESG was really just big tech and sort of in drag. And so you're going to see, as inflation picks up, you're going to see the rest of the ESG kind of have to have a bit of a performance chase and have to rotate into stuff that's working. And so you'll see a lot of justification of where they can kind of enter the energy industry. So nuclear, uranium's an obvious one. They can say that's ESG friendly, and even stuff within the oil complex that they can sort of say is helping produce energy more efficiently, more low carbon, then that'll probably get ESG money. You forget how much it's all just really a big performance chase. And the only reason ESG has been so popular is because it hitched its horse to tech and was short energy at a great time to do that. It was the perfect sort of long short trade for a few years there.
Yeah, absolutely. And then you're saying asymmetrically, coal is probably the best setup. And most investors are probably going to think, okay, great. Ferg said coal, obviously everyone hates it, but then over time they'll say coal, like everyone hates coal. So are there any numbers you could give us in terms of the demand? Like, I know it's similar to oil in terms of the setup, but why coal?
Yeah, so coal's interesting because coal is, when you see a lot of the essentially the forecasts of how much renewables going to make up of the world, like the sort of the IEA, it'll make up 90% on wind and solar, and coal is really the beneficiary of the underperformance of those projections. So the inability of, I just think it's crazy that they expect a lot of South Asia and even China to be completely reliant on sort of renewables when they'd be putting their energy security at risk, and they have large coal reserves. So it doesn't make sense to me. So that's where I see a lot of coal demand staying steady. And even if you run the numbers, like I ran the numbers and I wrote a blog on it, and even if you take sort of everything that they're possibly talking about taking offline in Western countries around the world for coal, it's largely offset by all the coal development in the emerging world. So you pretty much get back to break even, and so it's literally not going anywhere, and yet we're just destroying supply everywhere. Like we're just you almost can't. I've talked to a few coal CEOs now, and it's just so difficult to get anything permitted in Canada, US, Australia, and that's where all the big coal reserves are. Like if you had to break down a lot of where the coal is sort of globally, like Russia's probably the one that still pushes it. South Africa's a mess. Indonesia's pumping it out as quickly as it can. But yeah, obviously Canada, US, and Australia are doing everything they can to sort of to stop the industry. Like you had, even in Australia, it's interesting, they had sort of a nun and a few teenagers took Whitehaven to court and sort of got a decision that it's, sort of building new mines is sort of damaging children's future. So they didn't get an injunction to stop the current developments, but it was a pretty loud sort of warning shot that probably going to be very difficult to get new mines permitted moving forward. And you're just seeing that all over the sort of the Western world. And so it's just, this is straight supply demand. Demand's going to hold up and supply is going to keep getting squashed. They won't finance it. They won't, they'll just keep capital starving it.
Unbelievable. Okay, so there is no replacement for coal in the immediate in the near term, period. No. Right. So it's very similar to oil, and you're saying it's probably even less invested in than oil, right?
Yeah.
Wow, unbelievable, so great. And thank you so much for your time. We're gonna look out for your research on food to see if you can find anything asymmetric there. So again, where can people go to learn more from this? It's just so valuable.
So I've got Twitter, newsletter, so just Trader Ferg Twitter, newsletter. You see it on my Twitter, and I also do 2 shows a week on Crux Investor. So those are pretty much where I hang out these days. Yeah.
Listening to people that have been successful and correct is always a good idea in the markets. So this was just such a great opportunity. Thank you so much.
Yes, thanks for having me back.
This discussion is for informational purposes only. Nothing in this discussion should be taken as investment advice. Guests are not compensated for their appearance. Do not base any investment decisions on the information presented.